Hey all, thanks once again to our FinTech and VC folks out here. So everybody's been sitting down, big step, stand up, here we go. Stretch the arms out, feeling good the afternoon. It was 45 in the morning and it's 90 right now. So I'm seeing a bottle of tequila, a few good looking folks laying out. They probably didn't know South by Southwest was canceled. And I think Marty said he's gonna rent the boat to see the bats tonight. It's gonna warm enough. So if you're here in town, fantastic. But great to be with you all today. Real estate, so this has been a fun day. We've talked about, 1,700% returns, 100x. There's still a strong majority of investors, especially in our family office world, that wants, 5%, 7%, double digit, because they want the return of their investment. So I think it's a great segment into real estate, and I want to invite Scott to come join me here. And so I'm Dan Kryzanowski. I'm an advisor partner at BV Capital. We have over 4 decades in the multifamily and industrial space across Texas. Big focus now, as I said, is on yield. That's what the market asks for. That's what we are providing. We have a fund that provides monthly returns, back-end promote, and all the bells and whistles that you have when it comes to real estate tax economics. So I'm happy to share more on that offline, but we have a fantastic panel with us today, virtually, and then likewise here in town. So as we get settled here, Marc, do you want to kick it off? I think you're on mute.
Yep, there we go. Let me do a brief introduction. My name is Marc Halle. I'm in New York and been in real estate for 30 years. Development, acquisition, construction, chief operating officer for a public company now called the Empire State Realty Trust. 20 years at running Prudential's real estate. I ran for 10 years, started and ran US real estate private equity. And then for 10 years ran global real estate securities. Ran the largest REIT fund in the world, and then left to start our own group and ParkLane Investors, where we invest across the capital stack in both public and private real estate. A little bit of different perspective. Not only am I investing and running real estate, I'm also on the other side of the fence where I sit on the board of a family office on the investment committee out of the Middle East. So both sides of the picture.
Up here. Next up, I want to shift to Robert.
Hi, Robert Mason. I'm in Atlanta, Georgia. I run Mason Capital Partners, which is basically the latest rendition of our family's real estate investment business. We started about 40 years ago. We sold a peach farm in Georgia, did a tax-free exchange, and started investing in industrial. We bought retail strip centers out of foreclosure in the RTC days. Became the largest outside investor for the original Marriott franchisee for the Southeastern US and kind of grew our business. I worked outside of our family's business for most of the early part of my career, went to Richard Ellis, then Wharton to get an MBA in real estate and finance. Moved to Chicago and worked with Hines, a Houston-based developer. Did that for about 4 years. My wife and I started our family, so I moved back to Atlanta, where I headed acquisitions efforts for Lincoln Property Company for the Southeastern US. Got to be very good friends with the Florida partner, Scott Staley, who's a West Point grad and a former corporate head of real estate for Disney. Left Lincoln and put a business plan that I had written sometime between CV and Wharton into practice for our family's business. We basically created an investment club where our family and some other high net worth investors and family offices invest with best in class sponsors like Lincoln Property Company in specific projects. We'll get involved early. We'll put up pursuit capital. We invest at the sponsor level. We'll help bring the rest of the capital stack and solve problems. So we have partners like Lincoln. We're involved heavily with them in Central Florida in particular. We have another partner that loves assisted living and has done about 300 deals in 40 states where we invest with them at the sponsor level. And then we have some apartment partners here in Atlanta that spun off of Cortland, which is one of the larger owner operators of apartments in the United States. So we have multiple sponsors where we'll get in early and invest at the sponsor level. So we recently completed the headquarters for SunTrust Bank, now Truist Bank, in downtown Orlando as part of our Church Street Station project. We also acquired the headquarters for the Tampa Bay Times newspaper in St. Pete. We downsized the paper, backfilled that space with some other credit tenants to strengthen the profile of the building. We've done hotels, apartments, office, pretty much everything. We're more focused on who we're investing with and the local market dynamics and fundamentals than we are, any particular niche within real estate. So that's a little bit on Mason Capital Partners.
Scott?
Thank you very much. First of all, I want to start out and say I appreciate Ari Rastegar letting me come in and sub for him today. Those are some pretty big footsteps to fill. All of you that have heard Ari speak in the past, we're certainly real proud of what he's built, and we're just taking it and running with it from there. Marty, I want to thank you very much for putting on another incredible conference during a very difficult time. Certainly that, and Dan, thanks for moderating us. Rastegar is a fully integrated real estate firm based out of Austin, Texas. We have two offerings out right now. We have a private REIT for retail investors. We have an institutional offering for institutional investors. And then we have co-investment opportunities in various verticals that we specialize in or believe have more confidence in. 50 years ago, a little company called IBM moved to Austin, Texas. And, I'm 54 years old, born and raised in Austin. And this isn't an Austin speech. However, I am going to say Austin's needless to say, a pretty special place to be from and live. Spring forward, 1984, a little company called Dell Computer set up shop. Dell set up shop out of the garage, and it's grown. The rest is history. 2013, Google Fiber invested about $1 billion in Austin, Texas infrastructure. On the heels of that brings us to today, and you've got little companies like Amazon, AT&T, Oracle, et cetera, moving here, and this little company called Tesla. Now, we believe that with a low interest rate environment and a 52-week high environment or 52-week high on the stock market today, we believe real estate's pretty compelling, not just in Austin, not just in Texas, but in the Sun Belt communities, Sun Belt states. The Sun Belt is the lower 15 states of the country, and along that you have four of the largest cities in the country, or five of the largest cities, and four of those happen to be in Texas. So we're pretty bullish of what's out there and our capabilities within that arena. Just want to let you know that, with the expansion going on and all the growth here in Austin, and not just, once again, the 35 corridor and the Sun Belt, we feel very compelled with a very tough entry point of finding and sourcing deals. We feel Rastegar's put together a winning team to be able to source those and put those in the end zone.
Wonderful, great stuff. Thanks, Scott. Let's go in the same order, Mark. Where do you see the most opportunities for your business in 2021 and beyond?
It's Dan, I think you're speaking. It's very hard to hear you. Sorry.
Yeah.
Do you mind repeating?
Yeah, we still can't hear you. Oh, there we go.
All right, third time's a charm. Here we go.
Oh, there we go. Perfect.
All right. Where do you see the most opportunities for your business in 2021 and beyond?
Is that for me? I guess I'll take it. So look, if you look at the macro backdrop to where we are today, there's a confluence of factors that are all pointing upwards, right? We're right in the middle of a massive global stimulus, 57% of US GDP. Globally, it's 36%. I think that was the number. If you combine the fiscal stimulus, savings, growth in core income, consumer net worth, we're going to have about a 9% year-over-year GDP growth by the fourth quarter, and about 4 to 6% for the next year, 2022. Really unprecedented. If this is likely going to be the strongest growth in since the 1950s, I guess, for the dollar. We're going to push 10-year treasuries probably close to 2%. And again, strong dollar. You've got foreign vaccinations and reopenings, Eurozone, Japan, Canada, are really lagging, which is another tailwind for the dollar. This is not news. The market's already priced this into stocks and bonds. When people say we're forecasting a return to normal, this is not normal. The new normal is going to be better than normal. So we're really going to see a growth in the market. We're going to see inflation. And that's a good environment for real estate. Now, real estate's always a lagging economic indicator. So as companies grow, as they hire more people, as they take more space, as they spend, it's going to take a little while for the impact to hit real estate. Coming out of COVID, there's some fundamental questions to be resolved. In my 30 plus years of real estate, I never had a question whether or not real estate was coming back. It was a question of how long till it comes back. Today, you've got some interesting kind of hits to the markets where how does office come back? Do people want to be in CBD offices? Right now, people are estimating about a 10% decrease in space. Business travel, the fact that we're doing this on Zoom, but in the future, will there always be a Zoom component to conferences? So when you look at the opportunities, let me break it down into two aspects. One, you've got public REITs. Public REITs were down 40 to 50% during COVID, and they've popped up 50%, which means they're still down about 25, 30% from where they are. There's still room to grow in the public markets selectively. It's a bifurcated world. You've got data centers and you've got industrial companies through the roof. You still have office, some cheap or inexpensive stocks in lodging, and definitely retail has taken a hit. On the direct side, I tend to like smaller sectors where you can really make an impact. So single family rentals, urban retail centers where there's going to be an interesting confluence of logistics and retail and we can talk more about that in terms of omni-channel distribution, how that's affecting the sales and retailers. Data centers, I am full steam ahead on the board of a data center company in Northern Virginia, Loudoun County, and there's really no end to that growth in that business. So it's a selective approach to being in real estate. Some areas, regional malls used to be the mainstay of core bond-like investing, not anymore. There are some areas of retail today which are really attractive, but being hit by the whole retail downdraft, and those are some attractive areas to invest in. So let me stop there. We can move on and talk specifics later.
That's great. Thanks, Mark. Robert?
Gosh, great answer, Mark. We tend to focus, basically on supply and demand. We've done about 100 deals across the Sun Belt states, all asset types. We've done a lot of hotels. We see hotel and retail as being more challenged than most of the other asset classes. We see industrial and apartments being very strong. And we see select opportunities in office just because some of the bidding is quieting down, and where we can get hold of strong credit tenants at long-term leases. We've in kind of some of our contacts in terms of talking with businesses, CEOs, at the beginning of the pandemic, people's productivity was really high. People were scared they were going to lose their jobs, et cetera. As the pandemic has gone on, the workers love the flexibility, but some of the C-suite's ready to get them back in the office to hold them accountable and to pass on culture, to train, the next generation, et cetera. So I do see, office is perhaps got its challenges, but we see some real strong opportunities there, particularly in states like Texas and Florida, where there's heavy net in migration. We're buying a building now where Disney houses their IT group, and we're seeing, Disney is now committing to relocating more of their California corporate jobs to Florida. So that will create a greater demand for office space, for instance. So we see opportunities really starting at the, with our partners in certain local markets. And again, Florida and Texas, or maybe I'd say Texas and Florida, Arizona, those will definitely be states where there's a massive net influx. And so we see opportunities across, many asset types. So that's sort of what I would add to Mark's comments.
That's great, Robert, and thanks for putting Texas first. We appreciate that versus Florida.
Texas is always first.
No taxes in either.
Yes.
Well, they say to follow the money. We're following where the people are going, and they're going to the Sun Belt states. The work's there, the people are going, and we're going there. The barrier of entry, having boots on the ground, incredible. And once again, we feel very, very bullish with the team we have assembled to do that, to identify those properties. Our main key focus in those states are vintage multifamily. That's historically your less than 100 units, over 10-year-old property. And I can tell you, by going out and kicking the tires myself in the field, these properties, our team that we have all in-house, it's not the proverbial lipstick on the pig. It's not. They take them down to the studs, they pull the copper, they do one heck of a job and create a nice product that's, in many cases, we call it the $5 Uber ride. If you're $5 from the main development, $5 Uber ride, scooter, or walk, then that's in play for us in those Sun Belt states. So we're pretty excited about that. And once again, I can't reiterate enough the ability to source these deals. We source them, we have a model that works, we wash, we rinse, we repeat.
Scott, great point. Let's go on that. Where do you guys source your deals from today? We'll reverse back.
Well, we've just recently brought in a gentleman, Neil Golden from Newmark, and he's the new president of our firm. And of course, Ari, once again, anyone that's met Ari in the past knows Ari is a one-man machine. And he sleeps very little. He keeps an incredible pace up, and he strives for the best, and he'll expect nothing but the best. That includes sourcing deals throughout the country, Sun Belt.
Robert, how about you?
We rely on our operating partners. We'll sometimes stir up deals, but we partner with some of the best operating companies in the country. We're very, very close with Lincoln in Florida, for instance. We're looking to redevelop the Sears parcel and the parking lots at West Shore Mall in Tampa, for instance. We've got a second tower that's coming out of the ground in downtown Orlando. There's basically 10,000 square feet of contiguous space, Class A space in the entire submarket of downtown, and a massive number of companies that are looking to relocate there. And then we have a keen interest in assisted living. We see the demographics behind that are very robust. So we have a partner who's rolling out a platform which will start in Central Florida and grow beyond that. So the short answer is our operating partners, who thankfully are some of the best in the business, are bringing us our deals.
Good stuff, Marc.
Yeah, a similar story. Getting contacts or contacts in the local markets is so important. Real estate, as Robert said, it's a local market business. And you could write a story all day long how office is the worst asset class to be in, yet any of us could show you a half a dozen deals which pencil out to mid-20s IRRs because of local market conditions. And so you have to be cognizant of that. To source the deals, it's almost like a flywheel. You start out day one and you're pushing, a big boulder up a hill. But as you keep pushing, you develop a network. And each of us has our local networks of people. For us, we use operating partners in local markets. They are eyes and ears on the ground that, sitting in New York, San Francisco, Chicago, Miami, we can't be in every single market. Two is we look at a lot of distress. So banks, servicers, they also have their eyes and ears on the ground. And, we talk to them about potential loans, which may be going bad. Or we talk to them about, opportunities where they see the market. And then we use brokers. And sometimes, we don't like to be in competitive bid situations, but sometimes brokers can source and control some very interesting deals. And, if we have a little more creative solution, we think that we can be a winning bidder. While you always have buyer's remorse, you understand that you can make money from those assets.
Well, I was just going to touch on, I totally agree with Robert and Mark. It's a real estate business. It's a roll up your sleeves contact sport. There's no question about it. So great job, guys, and across the board. During COVID, we closed 11 deals. 11 deals. Behind the scenes, we were sharpening the saw each day to prepare for when we came out of this. And it looks like things are happening. Obviously, I'm a very optimistic guy, very optimistic firm, and we think the future is very bright.
Hey guys, Robert, I'm going to start with you. What's your thoughts on distressed asset classes, distressed markets?
That's a great question. And I think that we've seen some longer term trends. I always joke that real estate's a little bit of a dinosaur industry, or we're black and white TV. We're behind, tech or venture capital a generation, it seems, but that's been changing. Every single asset class has been impacted by technology and changes. The pace of change is rapidly accelerating. For instance, Airbnb, Sonder, the Guild, some of those types of business plans are impacting hotels. Amazon has crushed retail. Industrial is now focused on the last mile. Office space has co-working space. All those things are happening. Those will all be challenges. But I think that understanding that and then being able to maneuver quickly, real estate fundamentals do still apply. A main location is still where people want to be. It'll hold its value better. And I think that it's important, more important now than ever, to be, well capitalized, to be conservative, and to take advantage of some of the opportunities. Construction costs are going up. That's a threat. It's harder and harder to build. But by the same token, once you have good product in the right location, it's harder to compete against you. So I think it takes a lot of patience, a lot of perseverance and wisdom. It's a highly capital intensive business that takes a long time. So it's still slow moving. But I think there are some tremendous opportunities to put capital in play in a smart way.
Great, Mark.
Yeah, let me jump in and try. You want to understand the source of distress. And is it, good managers can create value from bad real estate. Bad managers can destroy value from good real estate. And is it distress from management? We can overcome that. Is it distress from financial leverage, which we're seeing and which we will see a lot more of as banks get more aggressive in foreclose? There's been a lot of flexibility given to lenders over the past 12 months. That's going to start to dissipate. And then there's distress because, look, we're in a business where we have some of the most optimistic people in the world, which are called real estate developers. And if you give them $1, they'll build for $2 and borrow $3, right? And so sometimes you get really great projects that are in the worst locations, and those are hard to deal with. So we'll focus on the first two, where there's financial distress, where we can come in with something creative, or there's management distress where someone's not managed the property well. I'll shift focus a little and bring something in. And also, since I've been in the public markets for a very long time, looking at the public REIT markets, there's distress. And it's, you don't want to be in the index of the REITs, but when you look through specific companies, you're able to take advantage of that distress. And it's not rocket science. When any of us, we buy real estate, we look at a 3, 5, 7, 10-year discounted cash flow analysis, right? We're looking at how do we make money over time. When people are buying stocks or real estate companies, when they're buying REITs, I ran a $5 billion portfolio, and we had to have returns quarterly, every 6 months, every 9 months, every 12 months. Do I care between now and March 31st how my new office building's doing? No. Do I care how my stock is doing? Absolutely. Then you bring it, to hedge funds, which are invested in the stocks and the REIT market. Their idea long-term is 401, right? They look to say, how is my book look after the close? Am I covered, not covered? So the idea, if you're a long-term investor in real estate and you forget the analyst numbers, forget their pricing, they're all looking for 6 to 12 months. But if you're looking to 2-3 year returns, just like you would in real estate, there's distress in the public markets and you could take advantage of that and arbitrage that opportunity.
All right, so I was going to save it to the end, but the poll numbers are going crazy here. The flip side of distress, where is the holy grail? I'll go first. So I had tremendous success here in Texas and secondary, tertiary markets in self-storage in the early 2010s. We've all had great one-on-one conversations, but not our folks here in the audience or on the Zoom call. So Scott, start with you.
Well, I think there's always a bull market somewhere. And if you had to pin me in a corner going forward, I would say housing shortage, multifamily, vintage, and I would also say industrial. The 130 corridor that heads from San Antonio to just north of Georgetown, Texas, will be the industrial corridor of Texas, in my opinion, our opinion. We feel like it's like the top of a second inning ball game there.
Scott, that's a great point. And just playing on some of what our previous panel, so there was a great report by Josh Baer, who leads Capital Factory here in Austin, called the Texas Manifesto. So it's a bit bullish, but the thesis is that Texas is not only a country, as we always say, it's actually a city. Because think of our New Yorkers, it might take 3 hours to get from LaGuardia to Newark on a pre-COVID busy day. In Texas, we can get to any of the big cities within a 1 hour flight, a 3 to 4 hour drive, or with a VIP bus. So, on that standpoint, I think some of the asset classes you mentioned, Scott, are spot on. And for folks not from Texas, I would suggest reading this report because it really covers, I think, our 4 panels this afternoon of who the players are, who to talk about, and why everybody's coming to Texas. That was my commercial for the day. Marc, it looks like you had a top of tongue. I'll shift it to you.
Yeah, no, I love Texas, and it's such a specific. By the way, all the sirens you hear, I am in New York City. There's such specific opportunities. I love multifamily. There's a lot of capital chasing that asset class, that sector. We look at multifamily development. It's expensive. We looked at lumber. Lumber's gone up 400%. Steel has gone up. Steel's going up, and the attributable factor is Amazon. Building industrial warehouses is driving steel pricing. So I'm looking at sectors where the capital is not, sort of. When you look at the lodging sector, I want to differentiate between leisure hotels and business travel. I do think that business travel has been impaired to some extent. I think that leisure hotels are going to see a huge COVID bounce, 22, 23, 24, but yet they're all priced in the same bucket. Now, there is capital chasing single family residential, but I think that's a business that's been growing for 10 years and has another 10, 20-year growth cycle. It is the most liquid asset class in the country in real estate. You can buy and sell a home, 3 homes, 100 homes, portfolios. The professional management of them will make a big difference. And you've got a whole demographic wave of millennials coming out of school, coming out of their parents' homes, entering into child years where they don't want to be in New York City listening to sirens. They want to be outside on their deck, in their backyards with their kids. And maybe they can't afford the down payment, but there's a whole new asset class out there for them to explore.
Robert?
Yeah, I think great comments. As I think about real estate, there's supply and demand dynamics, there's capital, and then there's, net in migration, basically. So we're looking, we love the Sun Belt because we see long-term trends, and a lot of the trends that we're already seeing happening were just accelerated dramatically by COVID. online shopping, probably, I don't know if it was an 8-year jump forward or a 10-year jump forward, but it's here to stay. Zoom, this is now a fixture. And I don't think it would have happened nearly as quickly without COVID. So we've seen all kinds of impacts. But I think it's, again, it's still fairly simple, we think. Texas is phenomenal. And I think I've seen stats where 50% of the job growth in the United States over the last 40 years has been in 5 cities in Texas. So, that's a great place to be. And then it's just a matter of how competitive is it. Florida, we've seen massive in-migration. We find it to be a little less competitive and closer to me in Atlanta. So we love Florida for all kinds of reasons. But what we see, we're seeing opportunities both on the distress side, but we don't see those necessarily ripening yet. There's just so much capital. There's so many people sitting on so much cash. We've been watching the hotel sector, but we've seen people just extend and extend and extend. So we're made the decision to focus on just trying to get great credit. And maybe, take a little lower return, but really have solid credit with longer term leases in office or industrial, or finding places, just through our contacts where we can get hold of good apartment land at a reasonable price with some partners who can build maybe a little bit cheaper than some others. So, it's really hard, and it's such a local business. Strategies work. Every time a cycle happens, people get smarter and more money seems to flood into the industry. But that's what makes it fun and keeps it exciting. So, we're very excited about what the next few years will offer. And we think real estate's a phenomenal asset class, as a hedge against inflation with all the money that's out there. We see that coming. And as construction costs rise and it's more expensive to build, obviously that'll create some opportunities on the buy side as well. So it's kind of a variable soup, but it's fun to sort through it.
That's great. A question here, playing on Mark's point, if you had $1 on the multifamily side, would you go into AB or to workforce housing CD?
I would go into workforce housing. There's, everyone loves the, we call it the edifice complex, where they love to see more buildings, big pictures. This is what I own. And I think that the workforce housing has a lot more room to run. It has a much more stable tenant base. It has lower turnover. And so I think it's a great place to be in Texas.
But yeah, I would totally agree with Mark. We're getting very active in assisted living, and we think of it as a pyramid, and everybody wants to build uber high-end assisted living that's, $8,000 a month, but there are only so many people that can afford to pay that kind of rent. So if you think of it as a pyramid, you can play at the fat part of the pyramid. A, there's less competition, and then B, there's a whole lot more people that need it. So I think the same is probably true in the workforce housing front. So I guess that's where we would focus as well. We're doing a lot of development now in really high barrier to entry places. So a lot of our apartment dollars is going into new products, but that's also a little scary sometimes. But as a general rule, I'd bet on the fatter part of the pyramid.
Well, I will chime in, and thank you, gentlemen, and I agree with you. And one frightening stat here I have here is since the pandemic began, over 52% of young folks from 19 to 29 are living with at least one parent. At least one parent. When things, once again, as we continue to shine and come out of this, they're going to be looking for places to live, and I don't think they're going to go to the downtown high-rises.
Yeah, great point. As we look out here, huge price points here in downtown Austin, Texas. That said, I don't think my mom wants me going back home to Scranton, PA. So I like what Robert said. We'll find something nice and warm in the middle. Touching on the debt markets and with COVID, what's been the results on debt markets? What's the crystal ball over the next 18 months as it goes to real estate? Robert, I see you're shaking your head. I'll let you take that first.
Well, it's been interesting to watch. We just had finished building SunTrust or now Truist's headquarters in Central Florida as part of a larger mixed-use project, and went to refinance and take out our construction loan in June. Actually, excuse me, and we started the process in June. We closed in September, but we went to over 100 lenders with just an absolute trophy asset, and it was challenging. Had it been pre-COVID, we would have had a bidding war. Thankfully, we did end up with a small bidding war, but out of 100 lenders, we only had 12 or so showing up at that particular time, and it's gotten better. But they're, on the front end of any turbulence, my attitude, and I love banks, we can't do real estate without them, at least I can't, but they run for the hills and they kind of wait for things to settle down before they'll come back in. So we definitely saw that on the front end of COVID. I think now more and more lenders are getting back in. First of all, if you weren't, earlier in COVID, if you weren't one of their large customers, they didn't have money for you, no matter what your project was. That's changing now. And they're looking again at the quality of the sponsorship and the quality of the asset, which is where I think they should be focused. So I think, long story short, there's a ton of money. And I think as confidence continues to grow, we're going to have a lot of liquidity. So I think it'll be a great time to be putting money in play in real estate if you do it wisely. That would be my answer. So I think the debt markets are much, much better than they were, 9 months ago, and they're going to get better still.
I'll just add to that the lending committees at banks, they're watching CNBC, they're reading the papers, they're seeing the same things, and no one wants to get caught with the, why did you lend $50 million to that Class B regional mall? Everyone knew what was coming. Even so, the sectors that are hot, the industrial sectors, there's a ton of money out there. Data centers, a lot of money. Single family, there's Fannie, Freddie. There's multifamily, Fannie, Freddie. There's a ton of money out for those sectors. Try and get a retail project financed today. It's really difficult. So it depends, and it could be a great project, but no one wants to get caught kind of with their I told you so kind of syndrome. Yeah, I knew that retail side wasn't going to work. We read that in the New York Times. So it really depends upon the sectors. You have to understand where you're looking and work hard to get that money.
Great, Mark. I want to stay with you. Your opportunity set is broad, including the public and private, as you touched on, debt and equity. Let's focus on public opportunities. Why should a family office consider REITs? Do you consider them volatile?
REITs are stocks. They're also real estate assets. So prices go up and down in the public markets every day. The volatility is not risk for long-term investors. For short-term investors, it absolutely is risk. Boston Properties, Prologis, their stocks move every day and there is volatility. If you're a family office, a pension fund investing for the long term, that you should be able to look at the public markets and say, yeah, I can invest through the cycle. It's kind of looking at your own portfolio. When we're all guilty of it, right? We invest in something, you buy a stock, you buy a fund, you go and you flip up your phone and you look to see, how did I do this week? How did I do this month? Real estate is a long-term asset class. So there is more volatility. That volatility creates opportunities. The fact that we're talking that, we haven't seen distress in asset pricing. It's hard to buy distressed office today because no one's selling, right? But you can buy public companies trading for a 20, 25% discount to their net asset value pretty easily. So for investors who have the discipline to hold and not to trade, to invest, and again, invest means something longer than 30 days, looking over a 2, 3, 4 year cycle, you could invest in some of the best assets, best managers in the markets around the country. Remember that there's about $3 trillion of assets represented by the public REITs in the US. That's a lot of real estate. And it's biased or focused more towards the ABs than the CDs in that spectrum. So, you get companies with full disclosure, liquidity, and again, the volatility you shouldn't think about. I know it's hard, but for family offices and institutions and sovereigns, look past that and look at the returns, and you see that returns are as competitive or even superior to private returns over the long term.
That's great. Thanks, Mark. Folks, we got about 3 minutes left. I want to give each of you 1 minute, either with a bit of wisdom, something fun, or a call to action to the audience. Oh, this is my favorite topic. Thank you, Marty. Yeah, so tax advantage investing, opportunity zones, et cetera. Robert?
Well, people are going to do very well when you've gotten good real estate and opportunity zones. That's been very competitive. My traditional response to that is that's wonderful icing. We are more focused on cake. So we go after, really high quality projects in the best locations we can get. If it happens to be in an opportunity zone, fantastic. We've taken advantage of tax credits in all kinds of situations, but our personal view has always been, we're going to go get the best real estate that we can first. That said, there are people probably who are a lot smarter than me who've, pulled things together in opportunity zones and will do very, very well. But for us, that's always been icing. We're really focused on feeding our operating partners capital to get their, so they can buy or build kind of the projects they're most excited about. And we've found that those really strong operators see the best deal flow in those markets. So we've stuck to our knitting, following our
Love it. Thanks.
I happen to agree with Robert on that. We go out and find quality deals. 2 of them just happen to be in the opportunity zone. But as far as going back to the previous discussion, I think as a family office, I would align yourself with quality folks that have a repeatable process that goes back to know how to put the football in the end zone. Align yourself with those folks and hang on.
Yeah, I'll jump in quickly on opportunity zone, and I'm going to kind of echo Robert's comments and use his analogy. Focus on the cake, not the icing. I like that, so I may use that in reference to put a little asterisk there. But when going back to Robert's comment about the pyramid, there's very few opportunity zones and a lot of capital chasing those deals, and that's the top triangle of the pyramid. And if you have a lower cost of capital, if you have capital that's in need of opportunity zones, similar to the way people are using 1031s, it's that need driving the return. Great. If you can get it, good, but it's hard to get those deals. It's hard to get them in scale. If you focus on the mid-tier, the bigger slice of the pie, you're better off.
Thank you. Oh, I guess we're done. Well, that was great. Thanks so much, guys.
Thank you. Appreciate it. Thanks,
all.
Marty. Thanks, folks.
Fantastic.
Thanks, guys. So just some quick information. There's some questions that are being asked on chat. I know we didn't get around to them, but if you can just log in and go to the Q&A section and answer, that'd be great. My question on opportunity zones really wasn't about opportunities. It was about tax advantaged investing and what was the perception of how long those policies will be in place with Biden. But hopefully you guys can reply to that online via chat. It's exciting times, and although I think some people talked about the advantages of Texas, nobody really talked about the true astounding growth of Texas. Like anybody who knows Dallas, and we've been going there for years, knows that Dallas has grown a whole nother city in the last 10 years. I mean, it's amazing. And, Austin has its problems. Hopefully they'll do better city planning, but it's growing phenomenally as well. So great job. Thanks so much.